Hi, guys. Welcome to Burke Ashton Investors. Just came to the office a bit late today, and then fighting with all these FCI, the loan servicers, because there's a company. There's all these companies. Whenever you have either a rental, like a long-term mortgage on these properties, or you have these, this is one of those frustrating things that they keep basically having different servicers service these mortgages, and then they keep changing the servicers. And every time they change the servicers, it creates a mess in your bank account with all the payments that you have. And this is a racket for them to collect late fees, because every time they change it, every time it becomes an issue. And supposedly they're supposed to give you, this is by law, that they're supposed to give you 60 days grace period, because each time you change it, you may not be aware that they changed it. You may have sent a payment, and then so it's just every time they play games, and at the end of the day, you end up paying more money out of pocket, because they collect it, and then you've paid the money. It's out of your bank account. It goes over there and it sits in a suspended account. It's called. Or suspense account, whatever it is. And then it's like, hey man, how many payments are coming out of my bank account, and how much am I getting credit for on all of these properties? But it's just, anyways, it's a mess. It's part of running a business. So, okay. So the first question today is that Andrew just wanted to run something by you, see what you think. And this is about a property. It is not an auction property. It is not a sheriff's sale. Chicago Heights is a program for abandoned properties. I've driven around, found these houses that are boarded up. I would have to confirm with the city to see if these properties are on the abandoned property list. So, and then I may be able to see these. That is correct. So what this person is saying is, this is not going to auction. This is not a property that is on sheriff sales. So auction meaning online. He's referring to online auctions. Not a sheriff sales property, but this is on the abandoned property list. Maybe on the abandoned property list. If I'm interested in the property, then I make a $5,000 escrow fee to cover the legal fees, if that's the process with the city. The city will undertake the liens and delinquent taxes and have them eliminated, and the mortgage on the property. Yeah, that makes sense. Also, so there are a few programs like that. CIC has something where they do something like that, where let's say it's abandoned property. It's basically they want to get it back on the tax rolls. Nobody's been paying taxes on it. There's no mortgage, so they'll get all of that absorbed to be able to have an investor to come in, redo the property, because the property's so upside down, there's nothing that can be done with it. So let's see. Once this is achieved, the city will make the sale transfer with the attorney and clean title. The process may take 8 to 9 months. That's fine. My question is, would this be an acceptable method to obtain a property? This person happens to be in Mastery, and would this be something you guys would approve in Mastery? No problem at all. As long as the numbers work, there's absolutely no issue, and this is something that we would 100% approve as long as the numbers work. So it's really about the numbers. If the numbers are good on the property, we're good to go. You have no issue at all. Have you come across this process, and what would be the pros and cons of the approach in obtaining a property like this? So we have done a bunch of these. There are a few different people that have done these. I can think of Alexander and Andrew from Mastery off the top of my head. They've done this with a couple of these I don't know if you call them charities, but there are these groups. CIC does these, as I said, which is CIC, what's the full form for that? I'm just drawing a blank right now. The CIC in town, they do these also. So there's absolutely no issue with it. I'm reaching out to a lender to understand his perspective. I'm attaching the website below, blah, blah. Yeah, so there would be absolutely, so this is Denise. Denise, there would be no issue with it as long as the property, you're getting the property at the right number, right? It's absolutely like a regular sale, right? They're clearing out all the liens. It's coming in. Now, the only condition that I can think of, only condition is on some of these properties. I'm not saying on this one, but on some of these, you cannot keep them for a long-term rental. In most cases, they want you to put it back on the market, sell it, so that a homeowner has an opportunity to own it. This is not on all of them, on some of them, depending on what the rules are for that particular program. Secondly, sometimes there is a thing where they keep the first lien position on it. The lender would have the second lien position, and then they release the lien on sale. That has been done also in Mastery. It's not an issue as long as the lender understands it. That is something that's a workable scenario because that has been done multiple times. So it's not an issue at all. So yeah, as long as the numbers are good, it should not be an issue. If you need any help, let me know. So Magda, Ms. Magda was asking, what is the difference between REI apprentice, REI mentorship? I have no idea what REI apprenticeship is. I'm not sure where you got that term even, and I have no idea what REI mentorship is either. The only thing that we do is you can come to all the Chicago REIA meetings, also referred to as National RE Invest meetings. They're 100% free. There's no cost to it. You can come to them. You can come to any number of them. Absolutely no issue. If you are in Mastery, obviously there's a cost to it. Right. That's if you want more details about it, either talk to Miss Jennifer or talk to Lori about it. They'll be happy to explain exactly how Mastery works. But then you're working with us on a one-on-one basis. But I don't quite know what REI apprenticeship or mentorship, where you got the terms. But please reach out directly to either Jennifer or Miss Lori, and they will be happy to help you. The next one is property insurance recommendations during time of renovation. So depending on where you are, right, this is going to be state specific because insurance is based on a state specific basis. So if you are in the Chicago market, right, you can work with for insurance on non-occupied properties. So insurance is divided into occupied versus non-occupied properties. And it's basically based on whether the property is under construction or whether the property is going to be basically flipped, then that's different, or the property is for long-term, it's rented out. So in the Chicago market, we use Patrick's office here, McCarthy Insurance, and I will have Miss Jennifer send you the information for that for Patrick McCarthy. For long-term insurance, we use somebody from Mastery, from State Farm, Brulio's office for long-term. Now you should compare with Patrick's office for long-term insurance as well as with Brolio's office. Brolio's with State Farm, and I believe they have better rates for long-term. Not all the time, most of the time, but you should compare those. But I will have Ms. Jennifer send you details for both people, for Patrick's office as well as for the other insurance. But during the time of renovation, generally you're using a different insurance, which is done by Patrick. So hopefully that helps. What type of home insurance should I attain for STR? So Joe, that's a good question. Right now, we're using a STR, meaning short-term rentals, Airbnbs, whatever you want to call it. So there is a specific insurance that is being sold. There is a rider, I believe, that State Farm now is including that for short-term insurance. So so you should look into that. I don't have, and there are a few companies that are offering specific short-term rental insurance. We haven't used those yet. We're just using our regular coverage. So I don't have a specific answer, but we are working on finding that. What cities in Chicagoland area do not permit STR? So Joe, I don't want to put this out on specifically on this open forum. That's a conversation that we are, definitely willing to have with you one-on-one. So the other question was, from Abdul was I see a lot of wholesale deals are popping up in South Chicago, in south suburbs of Chicago, or south side of Chicago, specifically south side Chicago, Chicago Heights, Gary, Dalton, South Holland, Calumet City. Are those good areas to invest in? Excuse me. So it's going to depend, right? It's going to depend on what particular areas. So let's just say Chicago Heights. There are pockets of Chicago Heights that are pretty nice. There are other pockets that are a little interesting, right? Gary, I don't know, right? Gary is interesting to say the least. Now, East Chicago in Indiana seems like, at least the parts that I've seen, they seem pretty good working class type of neighborhoods. Dalton, same thing. There are pockets of Dalton that are pretty nice. There are other pockets of Dalton that are interesting, but still, I mean, Dalton is selling. South Holland, same thing. There's a lot of pockets of South Holland that are really, really nice. It has been very strong in terms of sales, but obviously when the interest rates went up, things changed. Calumet City, exact same thing. There are pockets of Calumet City, not the best pockets. There are other pockets of Calumet City, they're doing exceptionally well. So I think it's going to be pocket by pocket where you are investing. It's hard to make a blanket statement. Same thing for renters, right? Certain people have done very well with tenants in these areas. There's a lot of housing voucher choice program that exists in this area. So they have done very well. And if you compare that, because this person is comparing it to Naperville, that there's only one bank-owned property. Of course, Naperville market, you're not going to see as many properties that are bank-owned properties in a market like Naperville. So that is what it is. And what this person further saying is that in the high price range, there is no margin to do any flips. Agreed. That in AA area, it is harder to find properties that are basically, there's margins. Why? Because those are expensive areas. They're very, very, very high in demand. The greater the demand, the less the inventory you're going to see. The less the demand, the more inventory you're going to see. So, I mean, if you take Southside, if you take some of the neighborhoods where there are some challenges, that's where there's more inventory. Now, just because there are challenges does not mean that you can't buy a property there. The key becomes is which properties do you pick to do rehabs on, right? Just because there's a lot of properties available does not mean you go and do a rehab on the property. Just now, there's a property that came up. I looked at it and I said no to somebody in Mastery that do not buy this particular property. It's one of the south suburbs. Yet, in the same suburb, there is another pocket where I said 100%. This is a great property and the other one is not, even though price-wise, they were priced similarly. But on one pocket, it was a great price to buy this particular property. The other one did not make sense. So it's going to be based on the particular geographic location that you choose to buy. So it appears that that in good areas there are no deals. Abdul, that's actually not the case, right? What happens is this: like the property that I bought in Westchester, phenomenal deal. It's a good area, right? There's another property that Glenwood. Glenwood is a nice, solid area. That property I'm buying this week, phenomenally good deal. Right, nice, solid. Now, Westchester would be an A area. Glenwood would be a solid B plus area. Right, so there are deals. The problem is they're not as obvious. Right, you're going to have to dig in more. You're going to have to do some more work. You're going to have to look at properties that are off market. Right, Westchester deal, that was the property that was in the MLS. Went to auction. I bought it at auction. Tried to buy it in the MLS. Could not buy it because it was basically they just wouldn't accept the offer. But at auction, I was able to get it at a great price. In fact, $30,000 lower than I was getting it in the MLS, right? What it was listed for. Another property in Romeoville I bought. Great area. There's another property that I'm working on in Oswego right now. Phenomenally good area and great price. But mind you, it's tough, right? Because everybody, just like you, just like me, we're all looking for good quality properties at great prices in great areas. And that's where it becomes difficult. So the frustration you're feeling, there's nothing wrong with that. And it's totally, totally normal. So it's something that you just have to kind of keep an eye on. Next question was, what do I do? Do I get money from a private money? Does a private money lender make sense? Does it make more sense for me to go get the money from hard money, because the rates basically even for hard money today are expensive? And when should I borrow money from private money? When should I borrow money from hard money? And then what is the difference between opening a commercial line of credit? So let me kind of explain this. So there are three different things. You have private money. Private money generally is maybe your cousin, your aunt, your sister, whatever. If you're in Mastery, it's other people from Mastery that do millions and millions of dollars of lending. Like, so in Mastery, everybody goes to private money because it's the easiest place for people to borrow money. So there, the rates are 2 points and 1% a month. So if you're borrowing money for say 6 months, you're borrowing $200,000. It's going to cost you $4,000 upfront, which is on private money, and then you're going to get the purchase cost, entire purchase cost, and entire rehab cost, right? That's the advantage why people go and borrow money so many times from private money in Mastery. Now, you may have a friend, you may have a cousin, you may have anybody, your acquaintance, you can borrow private money from them. The advantage of private money is this, that if you take the time to build a relationship with people, sometimes you can get private money at very favorable rates, right? 5, 6, 7, 8%. You can get it at very favorable rates, and you give these people a good return, do a good job, and they will keep lending to you for years and years and years to come. That's how I did it. Like literally, initially, when I started, I used to borrow, and I didn't know it was called private money, but the conversation would be like, hey, man, I want to buy this property. I got $50,000, $60,000. I need another $30,000, $40,000. And I would basically borrow $30,000, $40,000 at the time to rehab the property, and then give them, if I basically borrowed a third of the profit from them, third of the purchase, third of the money from them, then I would give them a third of the returns, which was crazy, right? Now, without their money, I couldn't have done the deal. So for me at the time, it was like, well, something is better than nothing. Like literally, at times I gave half the profit away. I didn't know how to do it properly. That's all I knew, so that's all I did, right? I'm not saying you should do it that way, but that's how I did it. So private money is a fantastic tool, helps you to grow, helps you to scale. Generally, if you're from Mastery, what we say is borrow 1 or 2 loans from Mastery, and then you start borrowing from hard money. Now, if the loan is below 250, it makes sense to go to private money. If you're going to buy the property, rehab it, either put it back on the market right away and sell it as a flip, or if you're going to basically borrow that money and then rent the property out and refinance the property, then it makes sense to do it from private money if you're from Mastery. If you're not, if you have people that you can borrow money from, that you can have that conversation from, fantastic. That is something that if you don't know how to do it, you must learn, and it's not hard to do. I was the most skittish person. I did not want to ask people for money and get turned down at one time, because it hurts your ego. It's hurtful, right? I was like, oh my God, I'm being rejected. I'm being turned down. And I did not like that. There's ways of doing it. When we do that, one of the RIA meetings, show up, and there is a way of doing it where you do it in a nice way, and people will want to participate with you. They will want to be a part of your team, right? And that's a fantastic way. And you don't have to be the most outgoing person to develop that, right? That's something that I did it based on kind of presenting the property, and not enough time today to have that conversation, but that's something that we can certainly talk about at one of the RIA meetings. Second way is the easiest way, I think. If you have a little bit of money, like let's say you're buying a property for $150,000, and you're going to do 30, 40,000 of work. Either you're going to flip it, or you're going to basically rehab the property and keep it for a rental property or Airbnb or whatever the case may be. You can go to a hard money lender. Jesse at National RE Funding, that's National RE Funding, will be happy to look at that loan and fund it for you. And there's a lot of options. If you have some experience, literally, if you're buying a $150,000 house, you can buy it with 10% down, which is $15,000 down, and then they will fund the rest of the purchase, and they'll fund 100% of the rehab. So that's a great option to go, right? It's a phenomenal option to go. Now, if you're 10% of the purchase if you have experience. If you don't have experience, then they're going to do 15 of the purchase you're going to have to come up with out of pocket, and the rest of it, they will fund it. So if you have experience, you have to come up with 10% of the purchase amount. So they'll fund 90% of the purchase and 100% of the rehab. If you don't have experience, then you have to bring 15% of the purchase amount, and the rest of it, they will fund it. So 85%, they'll fund it, as well as all the rehab. Now, you might say, Andrew, do I have to have perfect credit? No, you don't have to have perfect credit, but you need to have some credit, right? You need to have decent credit score. It doesn't have to be perfect. You don't have to have a ton of money in the bank. If you don't have the money, you can partner with somebody who has the money, right? So if you're doing a deal where you're going to borrow, let's say you're buying the property for 150 and you have some experience, or you don't have enough experience, that's fine also, right? You got to have maybe 25, 30 in the bank, which is the down payment, and plus 3 or 4 months of reserves to be able to make the payments. So that's how they look at it whenever they're funding a deal. Last part of it is, well, when do I open a credit line? Now, mind you, this is not a credit line. This is not a secured credit line like you would do on a credit card, that kind of stuff. This credit line is, what happens is, let's say, hypothetically, you have 50,000, 100,000 liquid. You have experience. For a credit line, you need experience in real estate. You've done a few deals, right? And at that point, what they can do is they can look at your history. You've done some deals, and you have a little bit of money. Based on that, they can tell you, they can look at you, underwrite you, and then they can open a line, $1 million, $2 million, $3 million. We have people in Mastery that have an $8, $9 million line. Now, that's not money you can just go withdraw. I want to be clear about it. What that means is that the lender has already looked at you, and they say, hey, you're going to do 5, 6, 7 deals at a time? No problem. We have the line. Now you're not going to have to get qualified every single time. You bring us a deal, they'll look at the deal, they'll do the appraisal of the deal, and boom, you have funding ready to go, right? So what it does is they're underwriting meaning getting you pre-qualified based on who you are, based on your experience, and then you have this credit line available where you have access to the money in a short period of time. So you can quickly grow and scale that business. So hopefully that makes sense. The next question was, well, where are the rates right now? Well, it depends, right? Are you doing a rental property? So the rental rates right now on a commercial loan, we're talking about commercial loan, are going to be somewhere around 8% to 8.2, 8.5, depending on where you are, for a 30-year fixed. If you want to buy down the rate right now, it's not a good time to buy down the rate, because the amount that you need to pay to buy down the rate is very high. At one time during the pandemic, after the pandemic, the rates were very good, and you could buy down the rates by a point or so at very, very inexpensively. So at that time, it made sense to buy down the rate. So this just depends on where you are in that whole particular process. So right now, it doesn't make sense, but the commercial rates are somewhere between 8 and 8.5 on a 30-year fixed. And yes, rental properties are still working. Short-term rentals are still working. You just have to watch your numbers, right? That's just kind of what it is. And everybody is, if I'm buying a property, I'm paying the same rate as you are. Now, the next is, well, what about on a fix and flip? The fix and flip rates are going to be about 1.5 to 2 points. You're going to end up paying somewhere around 10%, 11%, somewhere you're going to pay. New construction, if you're doing that, it's a similar sort of a thing, maybe a little bit higher than a regular fix and flip. So the rates are a little bit higher, but that doesn't mean that you can't do deals. A lot of deals are being done. A lot of new properties are coming on the market, especially in the Chicago market as we're going into the fall and winter season. Now is the time, guys, to double down. So long-term rates are going to be the cheapest. Then it's going to be your fix and flip rates or a bridge loan type of rates where you're borrowing the money for 5, 6 months to do the deal and then either flip the property or to basically refinance the property to put it in a long-term rental. And then the last one is going to be for a new construction. Those rates are going to be the higher rates because new construction inherently has some risk with it. So hopefully these questions make some sense. Please invite your friends, please invite your family, make them a part of the Burr Cashflow Investor team so that we all get to grow. Keep sending in your questions. Thanks a bunch and have a good day.